Personal savings has plummeted. We've spent through all of the excess savings built up during the pandemic. Is this a troubling sign for the economy? I've got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. The consumer is 70% of the overall GDP. That's significant. I mean, the largest portion, okay? You got government spending, imports, exports. The consumer is really what drives things. And therefore, getting a sense on the health, the financial health and stability of the consumer can tell you a lot about where the economy is going. And yes, the stock market is a leading indicator of the economy, so it's going to move before the economy. But if you get a sense for where the economy is heading, oftentimes, not always, but oftentimes, you can get a sense for where the stock market's going. Does that mean you should be buying and selling and making some extreme moves? No, but it can help you manage expectations and maybe make small tweaks to how much you're investing or what your risk tolerance should be. So the consumer, it's been just this wild ride since COVID, okay? Because we had record unemployment and then all this helicopter money and then people couldn't go out and spend. So savings just built up like crazy. And it's been this it's been a hyperbole, really. We saw overall savings levels, personal savings levels, rise to just unprecedented levels. And then with that reopening, we all expected, people are going to be spending through those savings. Everyone's getting that COVID puppy, or everyone's putting in that pool or doing that renovation on their house, and then everyone's moving. So everyone's taking vacations, those sorts of things. So it was expected that a lot of that savings would be spent through. And a lot of financial experts were then saying, well, we would calculate that excess savings that's being spent and creating economic activity, creating profits for businesses and so on, will be spent through by X time or X time. Guys, it's here. It's here. Experts ended up getting closer and closer to, I think, all that pandemic pent-up savings is going to be spent out by the end of 2023, by the fourth quarter, the fall of 2023. Take a look at this. Nearly $5.5 trillion of excess savings has been spent through. Now personal savings overall is at a lower level today than it was before the pandemic. So what does this mean? As the economy opened back up, of course, people had excess savings because they weren't able to spend, and they spent that money. But then they've continued to spend and spent all of it, the rest of it. This is typical of a time where the economy is dealing with high inflation. So how much of this is, well, we were saving up, or we had this savings, this money earmarked for something, and that's why we used it? Okay, that would be a sign of healthy spending of that savings. But then unhealthy would be stuff just costs more. And I actually didn't want to spend that savings as quickly or for this, but I needed to because everything or life just cost more. That is a sign, this, inflationary times, inflation, that is a time when high inflation coupled with spending down personal savings or a drop in personal savings typically precedes or is right on the cusp of troubling economic times, recession. Ultimately, guys, the concern is this could lead to future slower economic growth. And I've seen some articles about this where the new normal, if you will, is going to be back down to GDP being absolutely anemic. Just really no economic growth because the savings that people have spent through has created so much growth already. It's not repeatable, right? Because that savings has been spent through. When you add on two additional items, I think it's going to continue to be challenging for the consumer and will limit economic growth. One is student loans restarting, student loan payments restarting. That's a net detractor from the economy. And I'm not making a opinion that, oh, they should have been canceled or whatever. No, I'm not sharing that. It's not about that. It's really, if you've got, say, a $150 a month student loan payment, well, for the last 3 years, that $150 hasn't needed to go towards a student loan. Therefore, it could go to Starbucks, it could go to, shopping, it could go to whatever, right? And now, starting in September, October, that money, instead of going to retailers or being consumed, has to go towards that student loan. They drag on the economy. The magnitude is going to be pretty significant on how that's going to limit the economic growth that we've seen over the past 3 years. Add on top of that, interest rates still being high for a much longer period of time. You take a look, I've seen some folks say the reason we haven't seen the recession that everyone anticipated was because individuals and businesses have been able to hold off and not borrow as much at these higher rates. They borrowed earlier when rates were low and everyone was expecting, hey, these are the lowest rates we'll ever see. And so people borrowed a lot then, businesses borrowed a lot then, and therefore they haven't needed to borrow at these excessive or these really high interest rates. Well, guys, the longer these high interest rates stay around, the harder and harder that's going to be. Have a lot of conversations with people that said, we really need to move, we've got another kid, or we want to be in a different school district, or our house has certain limitations and doesn't really fit our family anymore. But I've been holding off because I am enjoying this 3% interest rate. I don't want to go to a 6.5% or 7% interest rate. The longer interest rates stay high, the less likely people are going to be able to stay exactly where they're at. They're going to need to borrow at these higher interest rates, which again is going to create a drag on overall economic activity. You might say, well, wait a second, that interest is going to the banks and that will help them be more profitable, in a small degree, but I think there's a much greater extent that the higher loan payments that are coming with these higher interest rates, it's going to be a net drag on the overall economy pretty significantly. So listen, while it's fantastic that the stock market has rebounded this year, I wouldn't say that's a sign that things are all clear for the economy moving forward. Instead, I would encourage you to be diligent. Number one, being diligent in your overall investment approach and philosophy. This is, in my opinion, this is not a time to say, oh, the stock market's rebounded from the bear market. Things are all clear. Instead of being back to normal risk, I'm going to take higher risk. No, I would not. I would look at your overall financial plan. What's your financial plan say how much risk you should be taking? And I would stick to that. And then I would make sure you're diversifying your strategies so that if we do see a pullback or if we do see this anemic economic growth, that you've got the right investment strategies to navigate through that. But then the second thing I would do with this information is stay diligent and stay prepared for an economic slowdown for you personally. While it's easy to talk about the consumer in general, make up 70% of the economy, what's most important, the consumer that matters the most to you is you. Right? So you've got to make sure that your overall financial house is in order. That is having a 3 bank account system, which means you're managing your cash flow and managing inflation, managing and saving up for upcoming expenses. You've got a fully funded emergency fund. You're paying down debt or making sure that consumer debt doesn't take root in your financial life. And you've got all of that on a stable platform so that you can save aggressively for your financial future, whether growth is anemic, whether we do eventually see that recession, or whether all of this actually is just, some concerns that blow over and things are actually, marching closer and closer to all-time highs, that you're prepared for any and all of those scenarios. Work with your certified financial planner on that, on all 6 areas of your financial life, your present financial position, yes, your investment strategy, your tax strategy, protection plan, retirement planning, and estate plan. Work with your CFP who's helping you integrate all of those so that you can make great financial decisions. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.